There's something going on that nobody is talking about, but we really need to talk about it because there is a major pattern shift that is occurring right now and has been occurring just recently in global central banks deciding to move their gold holdings home. Typically, they will hold it at like a major depository like the Bank of England, but now they are bringing them home in a flight to safety. And then, in almost perfect harmony, the US dollar index falls below a key technical support level, making it even more clear what is most likely to unfold.
An increasing number of countries are bringing back their gold reserves to their own countries as a precaution against potential sanctions on their foreign assets, similar to what happened with Russia. They are also buying more gold as a way to protect themselves from high inflation. According to a survey conducted by asset manager Invesco, central banks around the world purchased a record amount of gold in 2022 and the beginning of 2023. Lynette Zang, chief market analyst at ITM Trading, highlighted that central banks are bringing their gold back home as a flight to safety. The value of the US dollar dropped to its lowest level in over a year. This happened following the release of data showing that the increase in consumer prices in the United States slowed down in June. Lynette believes that the decline in the index makes it more likely that certain outcomes will occur. Central banks are responsible for their country's currency, but the value of a currency can fluctuate depending on how the economy is perceived. In times of economic need, central banks may have to print more money because traditional tools like interest rates have been low for a long time. Increasing the money supply can help prevent economic problems, but it can also lead to the devaluation of the currency. In contrast, gold is a physical commodity with a limited supply that cannot be easily increased. Lynette believes that the gold is considered as a valuable asset that central banks use to protect their portfolios from factors like inflation and geopolitical risks. Lynette highlights that the central banks increasing their purchases of gold while reducing their holdings of the US dollar, and this shift is due to several reasons. Let's watch to Lynette Zang's interview, but before getting into this interview, make sure to give this video a big thumbs up and subscribe our channel.
Reality is on a global basis, and particularly with central banks, and who knows more about money than central banks. Gold buying is up and US dollar holdings are down. Let me show you what that looks like. What central banks use to protect their portfolio from global inflationary trends or geopolitical risk or many other things. Well, 69% of them allocate to gold. 41% allocate to tips. What's a tip? A tip is a bond that is supposed to reflect inflation, but they've been underwater with this rapid escalation in interest rates. So they have not done anything. In fact, they've hurt central bank portfolios. They have not protected it from inflation. And I'm sure if you as an individual have the tips, you know what I just said is true anyway. And then they shorten the maturity because remember, when interest rates go up, market value of the bonds go down, but the longer the maturity, the greater the shift. So they shorten the maturity to reduce that volatility. But the problem is then they have to when they have to roll that debt over, they're rolling it over into a higher interest rate, which costs more. That's true for central banks as well as individuals. So what is the safest and best thing that they allocate to? Obviously, it's gold. And we know that the dollar is dying, but we know so is the euro and the yen and the Mexican peso and every single other fiat currency out there. This is not just a US dollar issue. This is a global issue. And what are the reasons for increasing their gold allocation? A substantial percentage of central banks are concerned about the precedent set by the US freezing of Russian reserves. So what they want you to think, well, that was then, this is now. No, now builds upon what was happening then. And everybody was watching as the US used their global money system, the SWIFT system, to control Russia. Didn't work because Russia had gold and they used that. But 96% of central banks said that they use gold as a safe haven asset. And also for currency uncertainty. That's foreign exchange, which central banks and commercial banks use to trade with, right? To control the visible price that you see. The value of the dollar will continue to decline until it physically goes away, period. And we're very, very close to that. Could it be this September? Maybe. I'm seeing a lot of parallels between now and 2007 and 2008. But because they know that if you don't hold it, you don't own it, central banks now prefer to hold physical gold rather than gold ETFs or derivatives. They are not the same thing.
After the financial crisis, Western central banks implemented measures like near-zero interest rates and large-scale government bond purchases to stimulate domestic growth. These actions had the unintended consequence of boosting the value of gold. However, relying solely on the gold standard could limit the flexibility and responsiveness of monetary policies needed to address economic challenges effectively. Lynette believes that the rising price of gold is viewed as a sign of a failing fiat currency, implying that we may be nearing the end of the current currency's life cycle. Lynette points out a cup formation pattern on the graph, which is seen as a key accumulation pattern. Each time the pattern repeats, the cup formation becomes larger, indicating a potential breakout. Let's listen to Lynette Zang.
This graph goes back to when we first went completely off a gold standard. And all it really does is reflect the trading, how they're managing the markets. It does not reflect the true fundamental value of an ounce of gold. They're taking advantage of it. You should too. But back in 1970 or prior to 1971, gold was fixed at $35 an ounce. Then, when they took us off the gold standard and they went on this perception management campaign for us to think that gold had basically no value, it's just a relic, even though it's used in every single sector of the global economy. But I want to point out the cup formation, which is a key accumulation pattern. When it broke out, how much it went up, right? Went up pretty substantially. Actually, 825 intraday. Then the second cup, remember Y2K and how everybody was all concerned, the problem with the computers? Interestingly enough, gold spot went down during that period of time, right? Crisis brewing. We don't want people going to gold. Let's push it down. Here's your cup formation, and here's the breakout. This was 2004. I remember it really, really well. Now here is the most current cup, and I'd like you to notice that every single time the whole trend evolves, the cup formation is larger and larger. Every cup. So, are we about to experience the ultimate breakout? Because a rising gold price indicates a failing fiat currency, and we're at the end. This was the beginning of that experiment when they took us, Nixon, severed those ties, but now we're at the end. That's why everything is so confusing and extreme, because we're at the end of this currency's life cycle. Don't trust what you see on Wall Street, because it's for their best interest, not yours. And in fact, Wall Street fund titans are betting on everything gaining against the dollar. And this is part of what's making me wonder if this isn't taking us back to 2007. Dollar to weaken as Fed nears end of interest rate hike cycle. Remember how much the dollar went up? Actually, let me go back there and show you. Right here, okay? When Nixon took us off the gold standard, right? This is when Paul Volcker ratcheted up interest rates to 21.5% intraday, ended up closing in like 18 something. But They lifted interest rates up, and so that attracted people to the dollar. That's why when the Fed is raising interest rates, you'll see spot gold decline, right? Because after all, interest is more important than what you can buy with the dollars and what you're earning from the interest. I hope you realize I'm being absolutely, completely facetious, okay? So that's what happens. So the dollar weakens as Fed nears the end of its interest rate hike cycle, only if other governments are continuing to raise the interest rates up. So it makes it appear, one currency against another makes it appear, oh, the dollar's stronger, oh, the dollar is weaker.
According to the Invesco Global Sovereign Asset Management Study, more than 85% of sovereign wealth funds and 57 central banks surveyed believe that inflation will be higher in the next decade compared to the previous one. In this anticipated environment, gold and emerging market bonds are viewed as favorable investments. 68% of central banks have chosen to keep their gold reserves within their own countries, compared to 50% in 2020. What do you think the implications of central banks buying gold in record numbers are for the future of the global financial system? That's all from us. If you like this video, please like, share and subscribe our channel and click the bell icon to be notified for future videos.